Good morning, everybody. I'm Fabio Sdogati again, a professor of International Economics and Business at the School of Management of the Politecnico di Milano. This is my number 3 talk about Greece. You will certainly remember that in the past I had 2 previous videos talking about what was called the Greek crisis. And if you have the patience to look back at those videos, you will notice that basically I said there is no such a thing as a Greek crisis. I mentioned the hypothesis that most likely the crisis was about an opportunity taken by speculators to attack the euro especially. And well, what's happening now? What's happening is that finally the 16 countries governments, the countries meaning members of the euro area, have decided to shell out money and buy Greek bonds exactly the way I said it should be done. In a short paper I wrote and published on my website, scenarieconomici.com, I wrote on the 23rd of February that basically all was needed for Greece was that somebody would buy the Greek government's bonds. This is exactly what's happening. There's an agreement now among the governments of the euro area. They will buy, they stand ready to buy, I will explain why in a second, this slight correction, 30 billion euro of Greek government's issued bonds. Now 30 billion is a hefty sum, but it is really small money when we think about it carefully, that is against the size of the euro area. Germany is going to contribute that fund for about 8.4 billion, which is about 28% of the overall fund. France is contributed 6.3 billion, which is about 21%. Italy 5.5 billion, which is about 18.4%. And you realize, of course, that these ratios, these proportions, basically reflect the relative size of national GDPs within the euro area. Even Malta is contributing to this fund. She is contributing about 28 million euro, which is 0.1%. Now, why do I mention Malta and why do I emphasize that these governments are standing ready to buy Greek treasury bills? First of all, the fact that Slovenia, Slovakia, Malta, Cyprus are buying Greek treasury bills is a tremendously important sign of the fact that this is a euro area decision. This is Europe which is deciding to buy Greek government's treasury bills, and this is of tremendous political importance. The reason then I'm emphasizing that these governments are standing ready to buy Greek treasury bills is that Greece has actually not applied for this type of call it solidarity. I don't like this being called a bailing out operation. Greece does not need to be bailed out. It needs financing at non-speculative interest rates. 7% on the Greek government's treasury bills was a ridiculous percentage. It was a ridiculous return to be asked. We know exactly as we predicted that these interest rates are falling and that the euro is appreciating over the dollar. This is again a confirmation that my hypothesis was correct, that we would see the euro strengthening against the dollar especially, and of course against the renminbi, given that dollar and renminbi are in fixed exchange rates against each other. So what are we actually seeing at this moment? What's happening at this moment? What's happening is that Europe is finding its leadership again. There is a behavior which is a cooperative behavior among the 16 member countries. When this cooperative behavior is prevailing, then the euro appreciates, interest rates tend to fall, even though we know that 5% is the interest rate that is being asked of the Greek government to be lent money. That's okay, it is above market, it doesn't matter. Speculation is being punished. That's what we want as Europeans, mostly. The situation is stabilizing. We hope that the message is out and clear now for everybody. If and when other countries should find themselves in some sort of difficulty, then European governments stand ready to remind everybody that today the debt problem is not a European problem, is not a Greek problem, is not a Spanish problem. It is a worldwide problem, and the biggest problem of all is the United States government. So this crisis seems on its way to a good resolution. The IMF is standing ready to lend a hand as well, meaning buying bonds if that's necessary. Personally, I am quite afraid of IMF conditionality. As everybody knows, conditionality by the IMF is extremely hard, and I'm afraid that a rough recession could be induced in Greece. We'll see. Of course, there is a problem, since both the euro area and the IMF are helping finance the Greek deficit. There will be a leadership problem. I expect that even the sheer numbers will show that Europe will have the leadership. 30 billion are put up by European governments, 15 billion by the IMF. So there will be some conditionality. I hope this conditionality will not be too harsh in terms of cutting wages, cutting pensions, and therefore overall cutting aggregate demand, which is exactly what we define as a recessionary policy. Thank you so much. See you soon. Probably we'll have a chance to discuss about something else, such as the exchange rate between the renminbi and the dollar, given that, as you certainly know, the US Treasury has decided not to mention China as a currency manipulator in the Treasury's April 15 report. Thank you. Good day.